The government has made changes to mortgages in an effort to lower monthly payments and allow more young Canadians and first-time homebuyers a chance to enter the real estate market. As a real estate agent, I've seen these new mortgage rules being celebrated as a big win for first-time homebuyers. But I want to walk you through both the pros and the cons of these changes, as well as show you a clear example of what a 25-year amortization versus a 30-year looks like, so you can see for yourself how much it might save or actually cost you. By the end, I hope you'll have a better idea of whether or not these new rules are something worth pursuing when you start your home search. I'll provide my personal opinion on these changes as well, and I encourage you to share your opinions or any questions you have in the comment section below. My name is Jessie McLellan, and I'm a realtor here in Oshawa, Ontario with the Lisa Abbott team. I do my best to give you an honest perspective on our real estate market, so if you'd like to stay up to date on everything happening, especially here in Durham region, then subscribe to the channel and help me reach 1,000 subscribers. So here are the changes that were announced. Starting December 15th, the limit on insured mortgages is increasing from under $1 million to $1.5 million. Right now, if you're buying a home for $1 million or more, you cannot get an insured mortgage, and you're required to put a minimum of 20% down. This change will bump that limit up to anything under $1.5 million. This doesn't mean you can buy a $1.4999 million home with only 5% down though. It would still be 5% on the first $500,000 and 10% on the remaining amount, so it is still a substantial amount of money that's required for a down payment. Also, the government announced earlier in the year that first-time homebuyers purchasing newly built homes could qualify for a 30-year amortization for their mortgage instead of the usual 25 years. Now they've expanded that too. All first-time homebuyers, whether you're buying a new build or resale property, can now get a 30-year amortization. Plus, this option is also available to anyone buying new build, not just first-time homebuyers. And there seems to be quite a divide in opinions when it comes to these changes. Those who are in favor of these new rules say that this is going to help affordability. As it stands now, insured mortgages make up such a small percentage of new mortgages. First-time home buyers are struggling to qualify in markets where the average sale price is pushing them out of that insured mortgage price point. The cap increasing to under $1.5 million allows buyers to get an insured mortgage and put less money down on a home over $1 million, and the thought is that this will especially help buyers in very high cost areas like Toronto and Vancouver, where average sale price of homes can exceed those prices. They'll need less money saved towards a down payment to enter the market. Yes, they will still have to qualify for the purchase price, but they'll need much less than they did before and could benefit from a slightly lower rate offered to insured mortgage holders. Allowing all first-time homebuyers to get a 30-year amortization on their mortgage will also help lower their payments by a fair amount, about a few $100 plus depending on the price point of the house, but we'll take a look at the exact numbers later on. When prices are going up, it's the first-time homebuyers that are negatively affected the most because they don't own an asset that's appreciating in the market, so they're just watching their goal of home ownership get further and further away and more expensive. This will allow them to get into the market sooner, easier, and have more buying power and lower monthly payments. And as for expanding the 30-year mortgages to all buyers of newly built homes, this goal is to promote new developments and more housing in the future. With new construction projects currently not selling, developers are having to cancel projects because of the low sales, and in the long run, that's going to negatively impact Canada's housing supply and contribute to worse affordability. Essentially, it's using demand-side policies to create a supply-side effect. That's the gist of the potential positives of these changes, or at least how supporters of these changes are looking at it. Now here's the other side of the coin and what many are saying who do not support these changes. The first being that this is less about affordability and more about securing the votes of young Canadians in an upcoming election. On the surface, it sounds like it helps affordability, especially with first-time homebuyers, but in reality, it could actually have the opposite effect. Sure, it will lower your monthly payment by a couple $100s, but we've seen this play out before. We know what happens when you give consumers more buying power. They use that buying power to spend more. Also, allowing more buyers to get insured mortgages over that $1 million price point would increase the number of people paying the mortgage insurance premium, which is a substantial amount of money paid to CMHC. This will add more demand, and those buyers will have more purchasing power, and over time, that will artificially increase home prices and actually have the reverse effect it was intending to have on the market. On top of that, you're allowing buyers to go into more debt. Instead of needing well over $250,000 for a down payment on a $1.3 million property, a home buyer might need just over $100,000 for that home under these new rules. And going from a 25-year amortization to a 30-year has a high cost. The interest you pay over the course of the 30 years is substantially higher than the 25-year. And with it being an insured mortgage, that also means you have to pay the insurance premiums on top of that. This results in hundreds of thousands of dollars in interest and extra debt that home buyers will get themselves into, all while continuing to drive prices higher. Then there's the point about this helping create more homes by making it easier for buyers of new construction homes. The reason people don't buy new construction homes in this type of market is because they are expensive. The price gap between resale and new homes is huge right now, and 99% of buyers are not willing to pay $200,000 or $300,000 more for a home that they're going to have to wait 4 years for, when they could buy a comparable home that was built in the last 10-ish years for far less money on the resale market. There's also the concern about inflation. Prices have been trending downward, the Bank of Canada has gotten control of inflation, and a large part of inflation is the cost of housing. If this pushes prices up, this is going to negatively impact inflation as well. So that's how both sides are viewing these changes. Like most topics, I don't tend to lean to one extreme or the other. I see truth in both sides, and I'm probably somewhere in the middle on most of it. There is an argument for increasing the cap on insured mortgages because it's been at that cap for over a decade, I believe, and home prices have definitely changed drastically since then. But did it need to increase by 50%, and did it need to happen right now while the market has been correcting itself and the Bank of Canada is finally getting inflation under control? Probably not. I could absolutely see a world in which certain properties actually end up costing more money because of this change. Not only because of the added CMHC insurance, but because $1 million used to be a cutoff for a lot of people. Because under $1 million, even $1 less, you would need roughly 7.5% down. But over $1 million, even $1 more, you would need 20% down automatically. In moving that threshold up to just under $1.5 million, that could become the new cutoff for people. And buyers who were limited to properties that would have sold under $1 million can now pay $1,025,000 or $1,050,000. When it comes to helping sell new construction homes, I think as long as there is a big price gap between resale and new builds, you're always going to have a bit more difficulty selling new projects to buyers because the numbers don't necessarily make sense. But I would imagine that there's a lot of projects being completed in the next year or two that were sold at the peak market prices, and with higher interest rates, a lot of those who purchased at those higher prices were likely going to struggle to close, leaving a lot of developers in tough financial situations. And this could help some of those buyers close on those deals rather than having to take a massive financial loss or even potentially claiming bankruptcy. So instead of allowing the market to sort itself out and discover where the correct pricing should be, they're almost helping bail developers out at the potential cost of future affordability. Seems like banks allowed homeowners to extend to a 30-year amortization or more because they were in trouble during COVID, and now they're offering this to more people, and we're going to be facing a far worse problem down the line. We can see how this unfortunately worked out for the people who bought at the peak in 2022 and extended their amortization and increased their monthly payments as interest rates increased until they couldn't anymore. And if they were lucky enough to sell it themselves rather than have it taken by the bank, they still sold at a loss of tens of thousands or hundreds of thousands of dollars, and that's just off the purchase price. They too were sold on the idea of a lower monthly payment, and it worked until it didn't, and they had to renew at a much higher rate than they bought it at, and I would hate to see anyone else in that position. Now, I know from the many conversations I have with viewers and those of you who have become clients of mine over the last couple of years that many people watching this are first-time home buyers. Most of the first-time buyers who work with me from this YouTube channel are shopping in the $600,000 to $700,000 price point. So for this example, I'm going to use a purchase price of $650,000 and an interest rate of 4.5%. Assuming you're putting the minimum down payment of $40,000. Over a 25-year amortization, your monthly payment would be $3,690. Your total amount paid at the end of the 25 years would be $1,800,000. $482,511. That's $472,511 in interest. Now, this is assuming you're keeping a 4.5% interest rate through the 25 years, even though that rate would likely be different every time you renew your mortgage, as the most common term is only 5 years. But to keep it simple for this example, we'll pretend it's 4.5% all the way through. If we extend that mortgage to the new 30-year amortization, your monthly payment would be $3,386. So a roughly $300 per month difference. Of course, that would be higher on a higher price point. But that's a fairly substantial difference and would absolutely make it easier for a first-time home buyer to get into the market and would allow you to obtain a higher pre-approval as well. But the total amount paid after 30 years would be $1,194,464, which means it will cost you over $111,000 to extend your loan to 30 years and save $300 a month. Some of you may be looking at that and think that's insane, and some of you may be thinking that's totally fine with me, I want a lower monthly payment. And I'm not here to sway you in either direction. If you decide a 30-year mortgage is what's best for you, then by all means do it. And if you're a younger individual or couple, you'll likely have more time to pay it off, and your pay will likely increase over time as well, and maybe that extra money over time makes sense to get you into the market faster. But I want you to know the true cost of buying a home so that you can make an informed decision. That's what my videos are for. There's going to be a lot of people in the mortgage and real estate industry who are going to be saying this is a huge win for first-time buyers and that you'll be able to afford more, but they aren't necessarily talking about how much extra this could potentially cost you in the long run. Now, of course, there are benefits from not having to pay rent and future appreciation, but it's all something to consider together. In my opinion, the better way you could have saved a couple $100s each month on your mortgage is if prices continued to correct. If that $650,000 home came down closer to $600,000, now you're looking at nearly a $300 a month lower payment and even less overall debt and interest that will be paid. But instead, this could end up propping up prices higher than they should be. We will only know whether this impacts prices as time passes. With this coming into effect in December, it's unlikely we see any major changes at this time of year, but the first real test will be the spring market. As activity and sales pick up, will the majority of these buyers take advantage of the 30-year amortizations to try and get ahead of other buyers? And in the end, it just results in them bidding prices up higher anyways, but now they're all paying more interest on top? Or will there be enough inventory built up that the competition remains lower and most buyers don't feel the need to put themselves in more debt? If it were me and I was buying a $650,000 home here in Durham region, I don't know if I would pay the extra interest to lower the payment or to increase my buying power, because I can still get a good home in a good area, especially for a first-time buyer in that price point. But if it was going to bring me from a lower budget where I was maybe forced to look 45 minutes outside of Oshawa or continue to rent and push me into a price point where I could get into a home inside of Durham region, then that might be something that I would consider, but it does come at a cost. Thanks for sticking around until the end. I know that was a long one. I hope this video gives you some food for thought and helps you make the decisions that are right for you. If you have any questions or want to chat further about this or buying or selling a home here in Durham region, you can always book a call with me using the link in the description. Don't forget to like and subscribe, and I'll see you in the next one next week. Bye.